You know, by virtue of my position at the Capital Match Point, I have an opportunity to talk to entrepreneurs on almost a daily basis. Entrepreneurs that are seeking capital and in various stages of finding it. And one topic the conversation almost always gravitates towards is, what is your company worth? And after we talk for a few minutes, the answer usually comes back as something like, I don't know, maybe something vague, or just simply, I have no idea. And one thing that I can't stress enough is that you, the entrepreneur, regardless of what the investor is doing, because they're going to form their own opinion of what a company is worth, but that you, the entrepreneur who's seeking funding, have a very fact-based, analytical opinion of what your company is worth. Now, valuation admittedly is as much art as it is science, and everybody has their own way of doing it. The investor will think that something's important, and another investor will think that something else is important. So what I generally recommend is that you take at least 3 methods of valuation and look for convergence around the number. And chances are, if you do get to convergence around the number, you're on the right track. Now, whether you like that number or not, I don't know. But again, it means you're on the right track. And again, there are a lot of different methods of doing valuation, but there are 3 that I would recommend because they are widely used, and all of our investors will understand them. They're the price-to-earnings ratio, the price-to-sales ratio, and the discounted cash flow method of valuation. Now, the price-to-earnings ratio will require you to go out and do some research on publicly traded companies in the same market as your company. Find out what kind of price-to-earnings ratio that those stocks are currently trading at, and do some projection onto your company and arrive at a valuation accordingly. Price to sales is very similar, except that instead of using earnings, you use sales. This method is used a lot in industries that don't yet have a clear path to profit, and a lot of times this is common in very cutting-edge industries, but that do have revenue. It's almost a surrogate way that the market uses to assign value to a company. In the discounted cash flow method, it's a little different. What you need to do is make some projections about your company's cash flow out into the future, 5 years if you can, 3 years minimum. Discount those cash flows back to the present, sum them together, and arrive at a value of your company. Again, your opinion and the investor's opinion are going to be different. Your opinion is going to be more, probably not as conservative as the investors. But at the end of the day, it's something that you do need to have your arms around. So if you've got questions about valuation, give us a call at the Capital Match Point, because what we want to do is make sure that our clients are as prepared as possible when they engage in the capital raising process.